Welcome to EXP Express Notes discussing CIMA P3 performance strategy. Today we want to talk about the management of financial risks. This is a quite important area of the syllabus as it focuses on and gives a lot of attention to interest rate and foreign exchange risk and the sorts of things that companies can do to protect themselves against such risks. Before we do that, we want to establish the big picture in terms of appreciating what sort of risks companies are confronted with internationally, starting with political risk. Now, at this point, students should be very well acquainted with the model called Pestel analysis. Pestel analysis encompasses a look at the environment in which a company is performing and breaks down to identifying and evaluating political factors in its broadest sense of the word, economic issues relating to the economic policies that are conducted by countries in which one is operating, understanding the social environment, particularly with regard to tastes and values within the society, extremely important. Technological changes in the day of rapidly evolving technology, this is something which is unavoidable. Legal changes, which some people connect to the political. There is, of course, a connection between the legal structure and system in a country and the politics of a country. And finally, environmental issues, which have become increasingly important nowadays. Now let's turn our attention to interest rate specifically. Interest rate risk refers to the possibility of losing money, or notice here there's also a possibility of profiting from a change in interest rates, depending on whether you are exposed to the interest rates in terms of assets and liabilities. In other words, depending on the structure of a firm's assets and liabilities with regard to interest rates, a firm should be able to work out whether an increase in interest rates will actually produce a profit or a loss to the company, and vice versa. If interest rates were to decline, what impact this would have on the assets and liabilities which are interest rate sensitive. This relationship between interest rate sensitive assets and liabilities is what gives rise to so-called interest rate gap exposure. And basis risk refers to the imperfections that exist when one is managing or protecting oneself against interest rate risk by entering into so-called hedge transactions or offsetting transactions, where the offset does not match dollar for dollar with the exposure that is being hedged, because the hedge transaction, the instrument that's selected for hedging purposes, does not move in price in line with the underlying exposure. This is a phenomenon that will become clearer as one considers the kinds of hedging instruments that a company can use in order to protect itself against interest rate risk. Now, in managing interest rate risk, there are certain things that a company can do of its own accord in terms of so-called matching and smoothing assets and liabilities depending on what their interest rate profiles are. Here we mean whether they carry fixed or floating rates of interest. The process of actively managing the relationship between assets and liabilities and their sensitivities towards interest rate, i.e. the gap exposures, would be the responsibility of a so-called asset and liability management group within a company. It's a treasury level operation and decision-making body. And one of the key instruments that is used by companies to manage their interest rate risk is the so-called forward rate agreement. And let's just have a closer look at what the forward rate agreement is all about. Let's suppose that a company plans to borrow in 2 months' time, and that we are here at time 0, that would be today, and the company expects or fears that interest rates may rise over the 2 months, and therefore the cost of borrowing will be higher when the time comes for them to actually take their loan. What the company can do at t equals 0 is to enter into a forward rate agreement, which would involve buying an FRA. Let's assume they buy the FRA at a contract rate of 3%. This means that the company is now protected and will not have to pay more than 3% as the base rate on which to calculate their borrowing. In other words, after 2 months, when they would take the loan, if rates have gone up, for example, to 5%, then the company, which has bought the FRA, has effectively protected itself against higher interest rates and will receive from its counterparty, that is the entity that has sold them the FRA, compensation payment that will be based on the 2% difference between the FRA contract rate, which was agreed to at the beginning, t equals 0, and the 5% rate, which is the market rate, which is observed at t equals 2. Now, the FRA is known as an over-the-counter instrument since it is contracted bilaterally between 2 parties. There are other ways in which companies can manage or hedge their interest rate exposure. For example, using interest rate futures, which is transacted over an exchange. So a company which wants to hedge its exposure can go to an exchange, pay a deposit called margin, and can trade interest rate futures. Here are some examples of 3-month interest rate futures that may be available on various exchanges around the world. The price quotation of interest rate futures follows a quite easy characteristic. Price is quoted as a discount from a par value or notional value of 100 face value. And price increments on futures are known as ticks. This is quite a technical area, and careful attention has to be paid to the characteristics of interest rate futures. It's important to keep in mind, as one works through the details of particular transactions, that the strategy which is necessary for a borrower is to sell interest rate futures. Here is an example. In this case, we have a company which is buying an interest rate future. So clearly this company is not buying the future in order to hedge a borrowing, because we just said that a borrower would normally sell interest rate futures, but interest rate futures can also be bought on the exchanges. And the interesting thing about the price dynamics of an interest rate future is that when interest rates go up, the interest rate future itself declines in price and vice versa. Therefore, a dealer buying a interest rate futures contract is expecting interest rates to go down so that his position, his so-called long position in interest rate futures contracts, will go up. The examples shown here serve to give a numerical expression to this sort of phenomenon. And the use of interest rate futures from a hedging point of view is also summarized here. So from a borrower's perspective, to hedge, the appropriate transaction is for a borrower to sell futures. That's an important anchoring point to keep in mind in order to not be confused with regard to what the appropriate hedging strategy would be. There follow other key features and terminology which the student needs to review and to understand, particularly the vocabulary connected with financial instruments of this sort. Thank you.